All right. Thank you everybody for joining us here tonight. My name is Shanice. I'm the marketing content coordinator over at Zing Credit Union. I help with marketing and education. So if you have any questions in regards to financial coaching, or if you want to get in touch with our marketing department, feel free to reach out. I'll make sure to drop my contact information in the chat box below. But I'm going to go ahead and cover some house keeping rules. If you want to leave your camera on, feel free to do so, or we just ask that you mute your mic. That way we're not interrupting the other attendees on this webinar. If you have any questions, feel free to add them in the chat box, or if you want to raise your hand with the little icon, feel free to do so and we'll answer some questions along the way. Or if you want to wait till the end, we'll also give some time for questions. With that being said, I'm going to hand it over to Maria, who's our business services program director. Maria, I'll go ahead and hand it over to you.
Sounds good, Jenny. Thank you for that.
Yeah.
My title is a little bit long. Hi, everyone. My name is Maria Sanner, and I'm the Business Services Program Director with Zing Credit Union. Tonight, we're going to be talking a little bit about buying commercial real estate with one of our partners, that is Centennial Lending. Let's go ahead and move to the next slide so I can start talking about the partnership that we have with them. Zing and Centennial Lending. We have partnered with Centennial Lending to enhance our services, and through a partnership with Centennial Lending, our credit union now is able to offer to all of our members a variety of commercial real estate loans. And let me tell you, why is this partnership beneficial to you guys? Mainly because you will have the solution to your hands. All of the individuals that work with Centennial Lending are very proactive and hands-on. The process is here, local. There is no prepayment penalties. You will have individualized service. And for the most part, depending on the type of loan that you're getting, it's done in timely manner. We're introducing commercial real estate to make our membership aware that we are a full service credit union. So we have from checking accounts all the way to commercial real estate now, thanks to Centennial Lending. And we have a consultative approach that is unique to Zing Credit Union. Here at Zing Credit Union, let me tell you a little bit of how we take care of our members. Our mission is educate, deliver, and achieve. We educate our members and deliver the right resources to help them achieve their financial goals. That's why we're here. What is Zing Credit Union? It's a non-for-profit financial institution. And what does that mean? That means that we are focused only on the community. We don't focus on profit or shareholders. We do have a board of directors that is elected by our membership, and we give all our earnings back to our members with lower rates and higher interest accounts. We have been operating since 1934. We started with the city and county employees, and then we opened our doors, and we now are offering memberships to 4 different counties: Adams, Arapahoe, Jefferson, and Denver. We also have a free financial education program that was established since 2005. And we want to be your mentor. We want to be your mentor. And each year we have been teaching 1,000 of people smart strategies throughout the free financial webinars and classes that we offer, like this one. And like Denise mentioned earlier, one of the things that we're known for is the ongoing one-on-one financial coaching classes. So if you're interested, at the end of this presentation, you can always shoot us an email or give us a call, and we're more than welcome to take care of your needs. Tonight, we have the pleasure to have Charles Wright with us. He is the Senior Vice President of Growth here at Centennial Lending. And without more to say, Charles, I leave the floor to you.
Hey, thanks, Maria. Hi, everybody. Yeah, just to add on top of what she just talked about, Zing and the credit union. Credit unions are not-for-profit financial institutions. They're cooperatives, and cool thing about cooperatives is they can get together and form sub-companies, and that's exactly what Centennial Lending is. We're what's called a credit union service organization. We were founded back in 2000 by 3 credit unions. To offer commercial loans of all things. Good conversation topic for today. We also offer residential mortgages, and we also collect loan payments for a handful of credit unions. We now have 24 credit unions that are our main owners. We work with about 100 of them, kind of around the Intermountain West here. We service a ton of credit union members and their loans, $2 billion in servicing. And our vision is to be the primary lending solution for all our partners and borrowers. So a little bit on us. So to get into the presentation, we're talking about commercial real estate and potentially buying commercial real estate. And I'd like to represent myself as the resident expert on the call today that you can ask any kind of questions to. And so questions probably work a little bit better in the chat. I'm all set up with the Zing crew to ask questions. I'll stop a couple times if you have questions in the middle of it. We're going to talk about why to buy. We're going to talk about some of the pitfalls of buying, a little bit of the process, and I'll give you some case studies on the whole thing. We'll probably focus a little bit more on when we talk commercial, how it's different from buying a house, residential mortgages, although some commercial is very similar. That's buying residential rentals and apartment buildings and all that. We'll talk a little bit on bigger commercial. We won't be talking about buying $25 million Home Depot office complexes and 50-story buildings. That's not really the credit union, and that's not really Centennial Lending. But I certainly can answer questions on that if you want. And we'll go from there. And so my first slide is why buy. And so the discussion is, why would you buy a commercial property, or why would you buy a rental, or why would you turn your house into a rental and move on? And one of the reasons is to build equity. If you are a homeowner and you want to continue to own your house, you have a mortgage, you're paying down your mortgage every single month. Hopefully the home is becoming a little more valuable as property values increase, as you make improvements to the house. And so there's reasons to maybe keep the house as a rental for a few more years if you move someplace else, build equity, or just to buy a rental house, buy an apartment building, build equity, have someone else pay down your loan and gain wealth that way. We'll talk more on cash flows in a minute, but cash flows are a huge reason why people keep rentals, buy apartment buildings, buy mixed-use properties. It's about bringing money in the door and bringing cash in. Think of it when you buy stock in the stock market. The value goes up on paper, but you never really see the cash that comes out of it. On cash flow on a rental, hopefully someone's paying you rent that's a little bit more than the mortgage that you're paying on the house, or maybe you own it free and clear, and you have cash flow coming in monthly. And that's not just current cash flow, that's future cash flow. And so one strategy on buying rentals is, how much is your rent now? Is rent going to go up later? Is your loan going to be paid down a little bit later? Will you have future cash flows farther down the road? And part of it is maybe retirement sometime later. Maybe you're not a big stock owner and a 401k owner, but maybe you own multiple rental properties. Well, that future cash flow is your retirement. We'll talk more on cash flow and get into a couple examples in a minute. One of the reasons people buy commercial properties is control. This is big on if you're renting right now in a residential rental and you want to buy a house. The problem with the residential rental is if your landlord sells the house, the new person that buys it may not want you in the house and they might kick you out. Let's say you're an artist and you want to paint all the walls green and red and black and do all sorts of crazy things. You can't really do that in a rental house. Let's say you're a store owner and you own a liquor store or a donut shop or a cafe, and your landlord is threatening to up your rents or sell the property or change something, and you want more control over your space and you want to own the property for some time later, you get a lot more control if you own it versus paying rent. More on that, depreciation tax benefits. You have to talk to your tax accountant for the real numbers, but you can write off a lot of expenses when you're dealing with rentals, and it helps your tax situation. Rental properties and owning commercial properties is a huge source of long-term wealth and wealth building. It's putting more money aside. It's diversifying your investments. It's a different way to gain wealth over the long period. That's traditionally been very successful. And then there's the last little piece I wrote down is there's a thing called a 1031 exchange. If you own a rental property and you've got a bunch of equity and you sell it, you have to pay taxes on it. Well, if you decide not to sell it and you're going to trade it into a different rental property, you can push off the eventual capital gains tax later on down the road. And so there's a thing called 1031 exchanges, and we do a lot of property purchases like that. Someone owns a property, they want to move to a new property, you can do it through this thing called the 1031 exchange and save yourself some tax issues for pushing them off farther down the road. And again, I'm not a tax accountant, I'm a terrible accountant, but things like depreciation, things like 1031 exchanges are a great conversation to have with an accountant or a CPA.
Charles, we did have a question come in, and we had someone ask what a QSO stands for.
Oh, good question. I usually make a joke about there's going to be a quiz at the end of the presentation for what QSO means. Credit Union Service Organization. And so what it means is a couple credit unions can come together, form a company. It's an LLC, so it's got multiple owners, and they can ask that company to help them fulfill services. Zing's a cooperative, and they're a different group of cooperative people than, let's say, a credit union in Wyoming or a credit union in Grand Junction or a different credit union in Denver, and they need some help with commercial lending. Well, the 3 or 4 of them can get together, form a company like Centennial Lending, and then we can be their collection arm. We could be their commercial underwriters. We could be their loan servicers. We can be their insurance companies. And so it's a way for cooperatives to form service organizations to help them provide services to their membership. And so Centennial Lending was formed by 3 partners, 3 credit unions, one in Boulder, one in Fort Collins, and one in Cheyenne back in 2000, what's that, 24 years ago, to offer commercial loans because they're pretty complex and they're pretty hard to underwrite and they're pretty hard to figure out. And they're regulated differently. And now, yeah, look, 24 years later, and we service a couple $2 billion worth of loans for about 100 partners. Did that answer that question? That's probably more than you asked for.
Awesome.
We're
And
an
then we did,
LLC owned by.
yeah.
Go ahead, please.
Oh, sorry about that, Charles. We did have another question come in. Will this webinar also focus on small businesses that buy a retail building under 2 million?
Under 2 million, yeah. I have a couple slides towards the end of the presentation, and we'll talk a little bit about residential rentals, and we'll talk a little bit about what a commercial building purchase looks like, and that'll come along in a few minutes.
Thank you.
Yep. Okay, so residential versus commercial, mortgages versus commercial loans. They're a little bit different. You know, again, fundamentally, it's the same thing. You're borrowing money. You're proving you had an ability to pay your bills on time. You're proving you have the money to make your payments and that the company is going to be able to afford it. But on the mortgage side, we live in 2 years worth of financial world. And in the commercial world, we live in 3 years worth of commercial world. So when you go to apply for a loan, you're going to have to provide 3 years worth of your tax returns and your financials. And we want all of them. And I make a comment to say that all the time. If you're borrowing a loan, borrowing money in the modern world, get prepared to provide all your financials and just provide them up front. Makes life much easier. We're not talking about GSEs and secondary market loans, so Fannie Mae or Freddie Mac. You can buy residential rentals with Fannie Mae and Freddie Mac, but for our conversation, we're going to be talking about stuff that doesn't quite fit that bill. Typically, these loans are 20 or 25% down, depending. Commercial lending is much more makes sense. And so sometimes it's 20% down. It may be 25, 30, 35%. Loan terms are limited to 15 years, and then they can have 15-year amortization. So what that means is every 15 years, there's going to be some sort of stop or balloon on that loan, but the payments can be based on a 20, 25, or 30-year loan. And that's very typical. And a lot of these loans are adjustable in the sense that they're going to be fixed for a set period of time. They're going to be the same rate for 3 years, same rate for 5 years, same rate for 7 years, same rate for 10 years, same rate for 15 years, and then become adjustables based on a 20 or 25-year payment. A little bit different than the way 30-year mortgages works. Lenders, people like us, people like the credit union, typically want the commercial building to cover the expenses of the loan. And so that question about, what's it like for a small business to buy up to a $2 million property? We're going to look at the property and what kind of rents it receives and what kind of income it earns. and doesn't make enough money to pay the loan off. That's a little bit different than residential. So residential, we're looking at the primary borrowers and do they make enough income that they're going to cover the mortgage. This side, we really want the building or the business to generate enough capital, enough income to cover the business a little bit more than what the payment's going to be. Global cash flow matters. And so some people own multiple buildings, and it's very typical to see one parent has a W-2 income and gets paychecks every 2 weeks, and the other person the spouse is self-employed, and let's say they own a liquor store and they have owned the building for a long time and they've gained income that way. And so the taxes are very complex. And so we want to look at, not just the W-2 income, not just the property throwing off cash flow, but globally, is the business partners or the people that are going to buy this building or the folks that are involved with this transaction generating enough cash flow that they're going to be able to pay the debt. And so think about that on a very fundamental level, right? If you get a car loan, right? When you go to apply for a car loan, the credit union wants to see that you have the ability to make your payment. You have a job and you can afford the payment. Commercial lending is the exact same thing, but it can be much more make sense. And if I own a house and I own a rental, and Maria owns a house and Maria owns a rental, and the two of us own a liquor store, and the two of us want to go buy a 5-unit apartment complex, on the commercial lending side, we're going to get all those tax returns, figure out what the income really is, and come down to a final number just to make sure that our loan is going to make sense. And so global cash flow matters, liquidity matters. And so when you're buying a house on the residential side, the mortgage side, you can really leverage yourself way into that house, and you don't really need enough reserves later, set aside in case of a rainy day. But on the commercial side, depending on the loan amount, we want to see that you have some savings built up. We want to see that you're a strong borrower. We want to be able to see that you have the ability to overcome weird stuff that happens, contingencies, a flood, a vacancy, something weird happening. And so cash flow matters, liquidity matters, experience matters. Experience is huge, right? If you own a tire repair shop and you've been in the tire repair shop business for 20 years and you've owned the building for 10 years and you're thinking about buying a new building, well, that's a completely different picture than maybe me, who works in credit union world, and I want to go start a commercial tire business, right? What do I know about tires? What do I know about the business? And so when we underwrite loans and we take a look at loans, experience matters. Things like make sense matters. Appraisals, if you use a Fannie Mae secondary market appraisal on your house, that's $400, $500, $600, $700. Commercial appraisals are more depending on the properties, and they're anywhere from $1,500 up to $4,000 depending on the complexity of it. So costs are a little bit more on a commercial loan. And then the cool thing about commercial loans is you don't have to do them to individual people. You can do them to LLCs. Those are corporations. You can do them to trusts sometimes. You can do not-for-profits. We do loans to churches and entities and to businesses and primary owners. And so you have a lot more flexibility to lend on to different entities. And entities, LLCs, I'll use Marie and I as an example again. We might want to form a company to go buy 2 or 3 rental properties, and that might be Chuck and Maria's LLC. Well, a commercial loan makes sense, and we could lend to that LLC. That was kind of a lot. Questions on that, maybe?
I'm curious about nonprofit borrowers. Do they have the
Yeah.
same kind of obligations, like to get to 25% down payment and things like that?
So a great question, Paul. I appreciate it. In our world, yes. Right. So there may be other lending institutions, SBAs and things like that, that have different requirements. So I will speak to my world. And so, yeah, we're typically 20 or 25% down when you're going to buy a building, if not more. The thing about a nonprofit is, again, you still have to have some ability to pay the loan back. And so that not-for-profit or nonprofit, how is it generating income? Does it have a history of generating income? And does that income make sense that it's going to be able to repay the payments that come back? And that can be in all sorts of forms. We did a loan for a church and they wanted to renovate one of the big Best Buy buildings and turn it into a church. And it seemed like a strange loan at the time, but the church had been very established, 25 years, had a huge membership base, and had a long history of money coming in and donations. And when you boil it all down to the numbers, the loan made sense, and we did the loan, and they bought the building, renovated it, and they're a successful organization moving forward. And so it kind of depends on the not-for-profit or nonprofit, and it depends on the money coming in, and it depends on how and what you're looking to go buy. Right? It's got to make sense fundamentally, right? We're not a grant organization, and so we're not looking to give money away.
Do nonprofits have the same mortgage rates or terms as business rates or terms?
With us, they typically do, and that's a credit union thing. Credit unions are one member, all members. So you can't just say the left side of the room gets 2% discount and the right side of the room is 3% worse. For us, it would be across the board. And residential mortgages, Fannie Mae and those guys have very set rates. Commercial is a lot more makes sense. And so 10-year fixed rate loan might be a little bit higher than a 5-year fixed rate loan. And you can do a lot more make sense type of lending. And so it's gotta make sense, but the rates would be the same. All right, so commercial property types. Again, I use that example of a big Home Depot anchored, a couple 100,000 square foot shopping center that you see off the side of the highway. That's not the kind of lending that the credit union does. That's not the kind of lending that most of the people on this phone call are going to be interested in. That's really not what Centennial Lending does. Typically, we see 1 to 4 family residential. And so I have a picture of a house that we closed recently in South Denver, and it's a 5-unit apartment. So it's someone took an old house, an old Denver fancy mansion, and turned it into 5 apartment complexes. And now someone bought it. We helped them buy it to use as rental properties. We do loans like that all the time. So or somebody in a condo complex owns 1 unit, but they want to buy the 2nd, 3rd, 4th unit and maybe own the whole building. We do loans like that all the time. Multifamily is 5 units and above. Just think of south of the main Zing branch on Acoma, or a little bit east, and you have all those 10-unit apartment complexes. We do lots of loans like that. They make sense. They're easy to figure out. A rental is a lot like a mortgage payment on someone's individual house. And so the numbers still have to work, but if you have a 5-unit apartment complex, you have 5 families or people paying rent. It's very easy to see the money that comes in every month, and then you can lend based on the money that's coming in to make sure that the property is going to pay for the loan that we're going to give you on it. Mixed use is a good one. You'll hear mixed use a couple times. A lot of times you have a commercial storefront on the main floor. Again, it could be a vacuum cleaner store, it could be a plumber's operation, it could be a restaurant or a coffee shop. And then above it, you have apartments. We do loans like that all the time. Again, it can be owned by LLCs. Again, you can have multiple investors. Sometimes commercial can be a GSE, a Fannie Mae, Freddie Mac loan if it's just single individual rentals. Sometimes people buy houses just to be a rental property. I've done that a few times in my life if you guys want to ask questions about that. Or sometimes people own a house and they want to buy a new one. And so instead of selling their house, they keep it as a rental and then leverage into the new house. And now they own 2 houses. 1 to 4 family, the residential style of properties, a little bit easier to understand because it really is a lot like a home loan that you got to go buy a house. The other side of that is when you get a little bit bigger, and this is kind of to that $2 million question and stepping into it a little bit more. Office buildings. And so office buildings for us aren't 50-story buildings, 20-story buildings. They're not the tough shit building off I-25 in Colorado. They're not the big downtown skyscrapers. They're more along the lines of a doctor's office or a dental office or, kind of a mixed use, multi-office. Dentists and doctors are the easy examples I can think of. You've got small offices for your accountant where you've got a building that maybe have 5 condos in it or 6 different spaces in it. We lend money like that all the time. The thing about offices is a lot of times people own their business and their business is successful, and now they're looking to either build wealth or solidify the business a little bit more or control their future of their location a little bit more. And the business being successful buys the building, maintains their space in the building, and they either grow into the whole building or they rent out pieces of the building. We see that a lot. And that's a wealth building technique. That's a stability technique. Again, that's 20-25% down on the building. The rents in the building have to pay for the loan, so you got to make sure the building is fully leased. We see retail, so think of going to the grocery store and look to either side, and there's usually 4 or 5 storefronts. We call those office condos, and there's a liquor store and a coffee shop and a bagel place and a Subway sandwiches and a vacuum cleaner repair store. We do loans for those 4 or 5 unit office condos all the time. Typically somebody owns one of them and is involved with it and they own the rest of it, or typically someone's going to go buy it because they're all leased out and those organizations are paying rent. You can buy the land for a Starbucks. You can buy the land underneath your Walgreens. You could buy the land for your shop to go, your automotive shop. We did a loan for a diesel mechanic recently, things like that. Excuse me. Mixed use, like I talked about before, you've got an office in the bottom and you've got rental units above and residential. Or mixed use, I should have gone back a slide. Sometimes you have residential properties and you have what we call a mother-in-law apartment, or you have a separate outbuilding, or you have a building, you have an apartment above the garage, or you have a mixed-use building that has a couple smaller buildings that are used as separate rentals. You can do loans like that under commercial. And then special use properties that, they really need to make sense. Special use storage units or storage yards or storage facilities for boats or RVs. We've done loans like that. I hate to say we've done church loans. Those make sense because there's a congregation supporting the church. We've done things like that. Construction loans for both residential construction and commercial construction. And so let's say you're an electrician and you own your building, but your business is thriving and you have a chance to go buy a couple lots across the street. We can help you buy the lots, credit union can, and then we can help you build a brand new shop to go run your business. So we've done loans like that all the time. And so if it's not a residential mortgage, if it's not a single family home and doesn't look like that, typically it's a commercial loan, and typically we can find a way to get that done, or at least we can talk about it. Questions about that?
I'm not seeing any questions in the chat box right now.
Great. Okay, so a couple slides on considerations when you're thinking about buying a rental property or you're thinking about buying a commercial property. And some of this is the math that you're going to have to do yourself as you start stepping into it. I'll give you some examples in a few slides from now about what some of those numbers look like and give you some real world examples. But income potential is one of the biggest things you should take a look at when you're buying a rental. Okay, what is the monthly cash flow from the rents that are coming in, and what is the leasable square footage, location, age, condition, tenant type of the building? What's the building like? Are you buying a dilapidated building that no one's rented for 10 years that you're going to have to put a ton of money into? Or are you buying an office condo where your restaurant's going to be one of the tenants and you're going to get rent from the other 3 or 4 or 5 tenants, and the property's in really good shape? And what kind of money is coming into it, right? I've said it a few times already, but you want the building you're buying to support the debt payment, to pay the mortgage payment, basically, right? Does the building pay the bills? Does the office, does the business in the building pay the bills? Okay. There's some tax advantages to buying your own property. And again, there's some wealth building ideas. As an investment, owning buildings and owning property is a diversification plan. It's an investment tool, just like stocks and bonds. Some people love only stocks and bonds. Some people love commercial buildings and residential rentals. Some people have a mix of the whole two. Owning a couple rental properties certainly falls into that. Different types of rentals, and CRE is commercial real estate. And so you can diversify amongst your commercial rentals. You could have a residential rental, you can have an apartment building, you can have a mixed use condo space. Other consideration, qualities of your tenant. Let me stop on that one for half a second. I've owned some residential rentals in my life. The quality of your tenant matters. It's probably right up there with the whole cash flow of the rents that are coming in. You don't want someone that's going to destroy your property, right? You want someone that's going to treat it well, take care of it, have some interest in maintaining it. And it's hard to find that sometimes. And it's hard to find ways to get rid of bad tenants every now and again. And so considerations going into a transaction, think about it. Would you accept a little bit less rent to have a little bit better quality of a tenant, or to have the ability to go pick and choose that tenant? Or are you just so desperate to get anybody in there that it really doesn't matter? And everybody's got different considerations when it comes to that. So quality of tenant's important. What are your rental rates? What are your lease rates? The person that asked about commercial buildings up to $2 million, when you look to go buy a building and you're looking at the rents that are being received right now, are those market rents? And it's kind of ruthless, but can you bump those rents over time and try to make a little bit more cash flow out of it? It's something to think about. Residential rentals, same thing. Are you cash flow positive? Are you making money off that? Vacancy. Now, this is another one. Nobody ever thinks about vacancy, right? But I owned a residential rental, and every 2 years, the person would move out, and I would have to go in, clean the property, paint and fix a whole bunch of work, re-rent it out, and that property would probably vacant 1 month a year or 1 month every 2 years. Well, that means 1 month that you're not receiving rental income from. And when you're doing your math and you're deciding whether you're going to go buy a rental property or not, you have to put some kind of factor in there to factor for potential vacancy, right? Times are good, everything's full, but what happens when someone leaves? Are you going to be able to re-rent it, and are you still going to be able to make income from it? And those vacancy costs are what's going on now. Are all the properties rented, or what's going on in the future? Do you feel like this is going to be a place that's going to maintain as rentals, or do you have long-term leases on it, right? Something like a mechanic shop might have a 5-year lease or a 10-year lease. A Walgreens might have a 20-year lease. So stuff like that is possible. Expenses, reoccurring versus non-reoccurring. Reoccurring, if you own a residential rental, your taxes are going up, your insurance is going up every year. If you own a house, you've noticed this in Denver, it's one of those great things. We're a loan servicer, and so we get phone calls this time of year because people say, why did my why did my payment go up? Well, your payment didn't go up, your taxes went up and your insurance went up. Are you paying attention and thinking about that? Non-reoccurring costs. Did the roof leak? Did the window break? Did the property flood? Is the sewer line broken? Right? Are you thinking about it when you're getting ready to go buy this property? That are you going to have a little bit of money set aside just in case a tenant moves out, just in case you got to get the sewer line fixed? Or do you have a little bit of money set aside, liquidity? Remember I said liquidity on that last couple slides ago, to be able to fix the little things. And the little things on a residential property might be a couple $1,000, but the little things on a property in downtown Golden might be $20,000. And so it's all based on a scale, right? And so when we're looking at the loan and we're trying to lend you money, are you capable of buying this building, and are you factoring in a little bit of extra just in case something happens? And you personally, when you go look and say, do I want to go buy a commercial property and do I want to step into this realm? Well, are you leveraging yourself 100% where you have nothing left over and you just hope for the best? Or do you have a little bit of money set aside as a just in case fund? Improvements, repairs. Again, you want rents coming in and you want people to pay on time and you want rents to go up a little bit. Could you improve the building? Could you paint it? Could you put new carpet in it? Could you fix the landscaping? Could you fix the gutters? Could you put a new roof on? Are you ready to go make little repairs like that? And again, I'm not telling you you have to. I'm saying when you're looking at properties, this is a great consideration when you're stepping into it. Market conditions. So market conditions is a great one. We're in a pretty stable and flat real estate market right now. It's been residential property has been going up for years and years and years. The value of residential has been going up. The commercial values have been going up a lot too. Well, the last 2 years, everything's really been flat. And so the property values have kind of stayed the same. And so when you look at your property, when you get ready to go buy it, take a look at the market around you and say, do I think this property is going to continue to appreciate? Or do I think it's going to stay flat? Or do I think it's going to maybe go down? And make that, make your buying decision on, put market considerations into what you're going to do with making your buying decision. And then property characteristics, neighborhood, zoning, future development, schools. I owned a residential property in a kind of a tough neighborhood on an edge of a busy road, and it wasn't near a school, and it was near an industrial complex, and we were successful and we sold that. And then a couple of years later, we bought a residential property that was in a very quiet neighborhood, near a church, near a school. Well, the tenants are totally different. The types of people that are living in the neighborhoods are totally different. I can't say one was more successful than the other, but depending on you personally and what you're looking at, especially with residential rentals, who are you trying to get in there and what are you trying to rent? Are you renting near a college, right? So DU in the middle of Denver or Metro in the middle of Denver, those are college kids, and that's a completely different crowd of people than, let's say, downtown Littleton, or where else? Golden, we'll use Golden as an example, right? So maybe those neighborhoods are a little bit different. I'm not saying one's better than the other. I'm saying consider the neighborhood, consider who's going to be your tenants, and consider what's going on. And then zoning, right? If some people buy vacation rentals, and you can certainly buy vacation rentals, properties that you're going to use on VRBO and for short-term rentals, what's the zoning requirement in the city? So City of Denver has some qualifiers to own VRBO and vacation rentals. Are you going to meet those? If you're going to go buy a house in Estes Park and use it as a rental property, well, the city of Estes Park makes you get a permit and a license. Well, are you considering that before you go buy the property? Questions on that? A lot of those considerations I went through them pretty quick, but they all kind of make sense.
No questions yet in the chat box.
Okay.
But I will let you know as soon as one comes up.
Okay, thank you. Question to ask as part of the property: are the current rents supported by the market data? And so if you're going to buy an existing rental and somebody's already paying rent, are they paying current market rents? Or are they paying below market rents? Or are they paying above market rents for that property? You can look that up. And you want to figure out if they're higher or lower. Or you as an organization, you own your electrician shop or your plumbing shop or your donut shop, and you are paying rent. What would that look like if you own the building? Would it be cheaper? Would it be more expensive? And can you afford it? And then are current market rents realistic long-term, right? So if you go into a property and say, God, I'm going to crank the rents by 100% and make all this money, well, is that realistic? If your rent's 100% more than the building across the street, my guess is everybody's going to go across the street versus step into your property. Question to ask: are current vacancy rates realistic long-term? So, vacancy rates around the Denver metro area in Colorado are historically kind of low. And so we've really never had much vacancy around here. It's always been around 2, 3, 4, 5%, which means you can almost rent almost any building immediately. What happens if vacancy rates go to 10%, or what happens if the economy turns? And so is your property sustainable? Will people live in that property and continue to live in that property? Can you raise rents? Again, this is the ruthless side of commercial loans and commercial buildings. You're buying this as an investment and you want cash flow, right? And so if you're an owner of a building, you're buying it so you can protect your lease payment so it doesn't go up. If you're going to go buy a commercial building, could you raise rents and make more cash flow or more income later on? Or could you spend a little money improving the property and raise rent sometime later on, thus making more money and thus making a little bit more profit for you? You don't have to raise rents. I'm not telling you to be ruthless, but that's a strategy out there that you should pay attention to. If you're in a rental property now, you don't own your house, you've had your landlord raise your rents, that's what's going on. They're looking and saying, hey, the market justifies higher rents. I'm going to raise the rents on all my rentals, try to make a little bit more money off it. Okay. And then do you have an exit strategy? And this is a great question, which I ask people all the time. Like, what's your plan? I have a friend that bought his first house, got married, had kids. 4 or 5 years later, bought a second house, kept a rental. 4 or 5 years later, the kids are, junior high school, bought another house. Now he has 2 rentals and a house. Kids are now in high school, bought another house. Now he has 3 rentals. Great. So he owns 4 houses. Great strategy. He's got cash flow, making money. This is his strategy on life. And I ask him, what's his exit strategy? Is he going to keep them forever? Are you going to pass them down to your heirs? Are you going to make $100 and sell it? Is it for your business and eventually you're going to sell your business? Doctors' offices and dentist offices and small business owners a lot of times will buy the property in their personal name, and then their business will pay rent to the personal owner. Well, the business is paying rent no matter what. The long-term strategy is that guy wants to own that property. And so when the dentist shop sells to the next dentist is now paying rent to the original owner. You have to have a strategy. And I guess is when you're asking questions and you're stepping to get into all this stuff and you're starting to think about this, think about an exit strategy, because you should always have one. Are you going to live in it forever? Are you going to keep it forever? Or is this 5 or 10 years and you're going to move on and retire? Risks, and I'm going to go through a couple of these. Tenant quality, we talked about that. Bad tenants recall source of trouble. Geographic, location matters immensely. That's the type of property in the area that you're living in is huge. Values are affected by that. Stabilities are affected by that. Environmental risks. Are you in a flood zone? Are you next to a mechanic shop that leaks oil? Are you next to a dry cleaner that releases gas? Are you next to a power line that might cause trouble? Are you next to a fire station that the fire trucks go off at 3 o'clock in the morning every day? Are you next to a train? Think about the environmental risk that goes along with it. Destructive leases, again, that's tenant quality. You've heard me say that like 4 times. Macroeconomic, big picture risk. This is something to consider also, right? Factors beyond your control. What if the economy tanks and vacancy rate goes from 4% to 20%? I mean, that's pretty drastic and pretty extreme, but if something like that happens, are you ready for it? What if the unemployment rate goes from whatever it is, 3 or 4% to 10%, right? What if inflation doesn't go down like everybody tells us it is, and goes back up to 8% and everything becomes more? Can we handle it? And then what if interest rates, which are high right now comparatively to the last 4 or 5 years, don't go back down and they go even higher? Can you live with that world, and can you live in that model? And again, I don't have the answers for you. I'm happy to talk to you offline and after the fact and have conversations about how I think about these things. But these are all considerations when you're looking at buying commercial real estate. Okay. And risks, capital requirements, and do you have the down payment? Are you going to be able to afford the maintenance? Can you afford future renovations? Are you going to manage the property yourselves? I mean, do you have the ability to go find renters and lease space for your commercial building, or do you need a property manager to come in and manage it for you? And property managers aren't bad. I mean, we have a couple borrowers that own 15 and 20 rental houses around Denver, and it's just too much for a single person to go run or a family to run. And so they sacrifice a little bit of income for a property management company to kind of go take over finding renters, collecting the rent, maintaining all the bills. They charge for that, but sometimes it's worth it, and that's a decision you got to make. And are you going to self-manage the property, or are you going to have a management company, which obviously you're paying for? Okay, I went through all that quickly, but I want to get into cash flow, and I'm going to go quick, and I'll stop after this slide to answer questions one more time, and then we'll finish it up with the last couple slides. So I keep talking about cash flow, and we want the building to pay for itself, and we want global cash flow to justify being able to lend money. And you guys want to look at it when you're buying a property. does this property pay for itself, or are you going to be able to pay the rent, pay the loan payment on the whole thing, right? And so here's an example. So let's say loan payments of $2,500 a month. Let's say it's a mortgage payment on a $400,000 house. That's about $30,000 a year in payments. Your rent payments, let's say you get $3,500 a month for rent. You're $1,000 a month positive cash flow. That's $42,000 a year. Your cash flow is $1,000 a month, or $12,000 a year. That's a pretty good residential rental. I mean, if that's a situation that you could put together, that's awesome. The couple of rental I've owned never were like that. We were much thinner on the margins, you know, a couple $100 a month. I was always okay with, and I was okay with it, right? But then when you look at that $12,000 a year, again, are you factoring in a little bit of vacancy? Because once every year, once every couple of years, or once every 3 or 4 years, no one's going to pay you rent while you're in there getting a new renter, right? Are you factoring repairs, right? So when you own a residential rental, and maybe you've all lived in rentals, when the plumbing breaks, you're the landlord. You got to go fix it. Do you have the money, or do you have someone that will go fix it, and can you pay for it, right? Are you factoring rising taxes and insurance? Taxes have gone up in Colorado pretty dramatically over the last couple of years, and I think they're going to keep it. And insurance in Colorado has gone dramatically up in the last couple of years. So when you look at that $12,000 a year worth of cash flow, next year it might only be $11,000 because your taxes and insurance went up. And then are you looking at future renovations, right? So stuff wears out. You know, when you own a house, and if you're a homeowner, you know, things break after a while. You got to fix the door. You got to fix the deck. You need roofs every 15 years in Colorado, right? Are you saving a little bit of money, and are you factoring in that rent? So when you look at this cash flow number, awesome, you're making $1,000 a month. But I think if you were to set aside money for vacancy repairs, future bills, and future renovations, you're probably only making $500 a month. That $500 a month is still pretty good, right? And so in your world, that might be okay. On the commercial side, you know, this is a residential rental example, but like on a commercial building, it's exactly the same. It's just the numbers are a little bit bigger. On the commercial building, sometimes the tenants pay for the repairs, they pay for the support of the building, you know, the maintaining of the surrounding land and all the operating external pieces around the building, depending on how you set up your lease. But still, you have to have some money set aside, and you have to look at cash flow when you're looking at buying a commercial property. Questions about that before I do a case study? Cash flow is hugely important when it comes, that's how we all look at commercial buildings when we go buy them. It's an investment.
Hey, Charles, I have
Yes.
a question regarding credit. So let's say I am a small business owner and my credit is not that great. Are we considering the credit for the loan of the business or of the owner of the business?
Yeah, it's a good question. We're kind of looking at both, right? So we're lending to the business, but the business is owned by somebody. And so in our world, when we're lending money to a business, we're looking for guarantees. We're looking for guarantees by the owners or guarantees by the manager. The not-for-profit question, same kind of idea, right? If we can get personal guarantees, or we can get an entity to help guarantee that the bills are going to be paid back. So we're kind of looking at both. What's the business? How's it rated? Does it pay its bills on time? Who owns it? Do they have good credit? Do they have cash flow? And when we underwrite the loan and we take a look at the global big picture, we're looking at the business and the people and combining them into one big picture. More questions?
Don't see anything yet.
One question I have is, like, do you ever do different than a 20% down, or is it always like 20% down, 25% down?
You asked that question before with us, Paul. In our world is 20-25% down. Now, SBA has programs. SBA is the Small Business Administration, where they'll go up to or allow 10% down. and they do typically they do a combination of a 50 or 60% first mortgage and a 30 or 40% second mortgage, and between that gets you up to 85 or 90%. Or there may be grant funds out there, but in Centennial lending world and in the credit union world, that space that we're talking to today, it's typically 20, 25, or 30%. Yeah.
So like if I have a group of businesses that are trying to figure out how to get to 20% down.
Yeah.
And so like, would you ever consider sources if they were able to raise grants and like get someone to give them grants? And then if they were able to do a crowdfunding campaign with, a group of investors that are part of their LLC, like, would that be able to get to 25% down, or is that way too funny creative for what a credit union would touch?
I'm going to start with it depends. All right. So let's talk rosy scenario. The money can come from wherever. We did a loan for a brewery to expand, and they had to buy a building to put more equipment in. Well, the brewery had a certain amount of money, but we borrowed some money from grandma and grandpa who pitched money into the deal. So in commercial world, you can cross collateralize to a point. And so if you had a business model where you said, we're getting ready to go buy $1 million building and we need $250,000, and we have 100 ourselves and we're going to get 150 from these sources. If we can track it and it makes sense, and if it on paper, everything's got to be there and it makes sense in the business case, then yeah, that's probably okay. Right. And if somebody gave you a grant and said you can use this money for whatever, yeah, that would make sense. And then we would look at that's the down payment source. And again, I'm not saying you should cross collateralize, but if I were to start a brewery and I own I have equity in my house, I could borrow money off my house to put down on the brewery, right? You can do things like that. Now, I'm not saying you should, and that's a business decision you got to figure out. But if you can see where the money's coming from and you can track it, and it's really going to go towards this, then yeah, then that's really possible. And then the other side of it is, what is the revenue of the business, and are they going to be able to pay the loan back with a little bit of extra? Right. So it's not enough just to buy the building. It's you got to buy the building and pay for the loan. And so that's all a little bit of a flux, right? So if it's a super strong case, maybe it's only tons of cash flow, maybe it's only 20% down. If there's no cash flow, maybe it's 30% down. So it's very flexible, and would love to chat with you more offline and get into it if you'd like to. Yep. Certainly have the capability on our side to get you involved with the lending team on our side and walk you through all sorts of scenarios if you'd like. Okay, case study. I'm going to do 2 case studies real quick. We're going to run out of time, so I'm going to go pretty fast. $450,000 purchase of a 3-bedroom, 2-bath house, 20% down payment. This is residential, $90,000. Current interest rates at 7.5. I guessed on that's about right. That's $27,500 a year. Taxes, insurance, $6,000. Total payments $3,000 a month. And so my case study is: do your rents on a 3-bedroom, 2-bath house cover the $3,000 a month worth of bill that you're going to be out there paying? And then I said, we talked about building equity at one of the first slides. The home value forecast of Denver area homes going up 3%. I think I used Lakewood for this one. Means that $450,000 house is getting $13,500 more value every single year. And that's part of the equation, right? So you put $90,000 down, you're making $13,500 a year, and it's cash flowing a little bit. That's a pretty good argument for a residential rental. That's kind of what they look like, right? And if you own a residential rental already and you're looking to go buy another house and keep it, that's a great example. Zillow's got a thing called a home value index, which is pretty helpful. Zillow isn't the end all be all for home prices, but they can trend you prices and tell you where they're going. On a commercial study, here's a real world example. We did a purchase of a $3.2 million 16-unit apartment building near DU. The loan we did was $1.8 million. That was 50% down. It was at 6.5. You remember I said commercial loans are often fixed for a set period and then adjustable. So it was a 5-year adjustable, same rate for 5 years. It adjusts once, same rate for 5 years, adjusts once, same rate for 5 years. And then it's got a 15-year balloon, and after 15 years, you'd have to pay it off. This person used 1031 funds. They owned a building in California and they were moving to Denver, so they bought a building. The down payment was $1.4 million, plus closing costs, and so appraisals and fees and credit reports and all that. The rate of return is 6%. And so what that meant was the $1.8 million that they loan that they had, after they paid all their bills, their down payment of a 1.4 million threw off enough income that it generated about 6% of a return on that 1.4 million, 1.64 million. This is a live property. This property is right near DU. If you ever drive down University, you see it. Go south of the highway and look on your left. It's one of the buildings right there. This is a great example of someone buying an apartment complex in Denver. They cost $3 or $4 million, and typically you're putting 50% all the way down to 20% down and basing it on cash flow. You know, that's a little bit different than the 450 residential purchase. The actual rate of return on this one's a little bit different, right? So $90,000 down payment, throwing off, you know, $13,500 a year is probably more like a 12 or 15% return on your money, if you look at it that way as an investment. Okay, considerations. I'm going to jump over the slide. If you're a commercial borrower, leases can be triple net, which means the tenant pays everything gross, tenant only pays some of it, or modified, some kind of combination. That's really only for big commercial buildings. And how to get started. Call a credit union, call a commercial broker to find properties, identify a property you're interested in, call Maria. Maria's great. And she can put you in charge of what the credit union, in touch with what the credit union has, or she can put you in touch with Centennial Lending. And I'm happy to share all of our information and put you in touch with all of our underwriters and all of our people. The first thing you would do, just like on a residential property, is go figure out what kind of money you have lined up and what you're looking at. Then you would go to a broker or a realtor and go look at properties and go figure that out. Maria's great. We also have a loan officer assigned to Zing Credit Union, Julia. She's also great. That's on his contact. And I'm sure Maria can share these slides with you guys if anybody asks for them. Either one of those contacts would be great. Or if you want to get a hold of me directly and ask questions afterwards, just reach out to the credit union. And I'm happy to pass my information. And if you want to get into any kind of deeper conversation or run scenarios or see what current rates are or see what the market looks like, happy to share. But we're right up on 7, and that's all I got. And any questions or anything else you'd like to talk about? Everybody's quiet. That's good. It's either good or bad. I'm gonna call it good.
Oh yeah.
Yeah, if you're thinking about buying residential properties, I've bought a few in my life. I'd be happy to walk you through what I did. And if you're looking at commercial properties, or if your building's looking, or that not-for-profit question, reach out and be happy to share information as much as I can. There's no cost to it.
Awesome. Thank you. We did have someone ask if we can get a copy of the slides, but we can definitely send over some information after this presentation. We'll send over an email just recapping all this information and a YouTube presentation as well. That way you have this and can refer it back as well.
Yep, yeah, happy to share.
Thank you very much. And I just wanted to know if you recorded this video, this presentation. I would like to listen that one more time.
Yes, yeah. This presentation has been recorded. And just give it about 24 hours and we'll put it up on YouTube. And once again, we'll send out an email with all this information, and you're able to just look back at it whenever is good for you.
Thank you. Thank you very much, Maria.
Absolutely.
Thanks,
All right.
everybody.
Yeah, well, I don't see
Alrighty.
any more questions in the chat box, but I just want to thank everybody so much for coming over to our presentation. I hope that you guys found this really insightful. Once again, I will be sending out an email with all this information and the YouTube link to this presentation. But if you have any other questions, feel free to reach out to Maria, and she can put you in contact with Charles. If you have any questions, you can also reach out to me at Janice. I did leave my contact information, I think, at the beginning of the chat box, but once again, feel free to reach out at any time, and we hope that you found this very insightful.
Yes, we appreciate
Thanks,
you,
everybody.
Charles. Thank you so much.
Yep. All right. Well, I hope you guys have a great rest of your night, and thank you again, Charles. We'll see y'all again soon.
Thank you, Janice. Have a good
Yep.
night.
Thank you. Bye, Maria.
Bye.